S. Murali wants to know what will be a better investment, sovereign gold bonds or RBI floating rate bonds for the same period?
Well, both of them are very different because the underlying asset class is altogether different. So I'll say that they're not very strictly comparable, even though the tenure of these two investments is somewhat similar. It is not very far apart. One is an 8-year tenured scheme, and the other is of 7 years. Now, so what I'll rather suggest him is to be guided by the investment objective or the purpose why he's making an investment, and then decide accordingly. So I'll just explain the purposes for which both of these can be useful, and hopefully that helps him decide which one to go for. Now, talking about the sovereign gold bonds or the SGBs first, well, we don't look very favorably towards gold as an investment. At best, it can be viewed as a hedge against equity during market downturns. If you look at historically, gold has done well pretty consistently during times when the equity markets are down and have fallen sharply. So from that perspective, certain investors like to add a certain allocation of gold in their portfolio in a steady state, as a store of value, or as a hedge against their equity investments. And for that perspective, for that kind of a need, I think sovereign gold bonds can be one of the preferred, in fact, one of the best investment alternatives to take exposure to gold. They yield 2.5% over and above the appreciation in the gold price, and the appreciation of gold price itself is tax free. So overall, it works out to be a good alternative if you want to take exposure to gold. Now coming to the RBI floating rate bonds, I'd say that they are a good option for your long-term fixed income allocation. Currently, they are yielding a return of about 7.15%, even though it is subject to resetting every 6 months. But 7.15% currently, in the context of the low interest rate environment that we are in, is a fairly decent return to get. So and also they can be a suitable investment for those who are looking for a regular payout, because these bonds pay out the interest, the coupon, every 6 months. So from that perspective, it could be a viable option for a fixed income investor. Now, basis these, he can decide which one suits him.